Good morning, good afternoon, good evening, and welcome to the Monday, the 8th of August Bull versus Bear webinar. Steve Miley on the call for trade day. Apologies for the slight late running, late starting here today. Also, just another piece of information today. There will be no webinar tomorrow. Just want to get that out of the way whilst we're at the beginning of the call. No webinar on Tuesday, the 9th of August. Unfortunately, guys, we will return with the webinars on Wednesday. But let's press ahead with what we have on today. So we're going to go through kind of our usual regular run through. Remember, on a Monday, slight different focus in here, in that we will start off by looking at the bigger picture, recap of last week on the macro fundamental events, and then also take a look at the upcoming week to give us an idea of I like to call the shape of the week. Okay, the shape of the week in here, because even if we're day traders, as we are at trade day. The fact is that, if we have a lot of volatility expected in the second half of the week, it's a lot of data releases or a lot of events, then the markets are like to be busy then. And then maybe for the first part of the week, it's going to be less volatility. So you might be adjusting your strategy. You might be adjusting your approach, because like maybe the next couple of days is going to be less volatile. And actually that is the case going into the beginning of this week, but we'll come to that shortly. So I'm going to do a recap of last week, then I'll take a look at what we've got coming up for the week. Then we'll run through some articles from the major news wires, just what's impacting markets right here, right now, on the fundamental macroeconomic geopolitical side. And then we'll take a look at some charts. So first thing in here, this is what I upload every weekend, guys. You should take a look at yourself, recap from the last week, look for the next week. This is where the technical analysis reports are. I just want to highlight the technical analysis reports in here. I don't often go through these. I'm not going to go through them now, but the first 6 in here are going to be on markets you guys probably don't look at for forex. But these are the reports that I send to my institutional clients, right? So these are going to hedge funds. These are going to institutional brokers. These are going to investment banking traders. So the first 6 are in here are all on FX. And then after that, we have stuff that you guys are going to probably be more interested in. So we have gold futures, we have oil future, we have the FTSE 100, which is the UK stock index. Probably not too interested in that. We are probably going to remove this and add in the Nasdaq. Some of you will be pleased to hear. So we're going to cover the Nasdaq future probably going forward from September. And then the very last one of the reports is the S&P 500. So just in case you haven't come across those yet, these are in, and I can't go to it now because it's where you're live streaming. The page you're live streaming on, the trade day at members.tradeday.com. In the members area, in the trading room, there's a section on technical and market reports, technical analysis reports. You'll find this in there. Okay. You'll also find in here this is the weekly update in here. So the sell-off in here. The sell-off. I'm just reading a question here from Clinton. I'll come to that shortly. So morning, by the way. I've seen some of you guys say hellos. Please do say hello if you're on the chat. Underneath the webinar, if you're live, there's a chat box, so you can go in there. So morning, Clinton. Morning, Tim. Morning, Kaz. So Clinton has a question which I'm going to cover now in the webinar anyway, in this first bit. So my question is, what triggered the intense selling on Friday right after the good jobs report? Okay, and then Tim's answer already. The good report will keep the Fed aggressive with their rate hikes, is what I believe. Very good, Tim. So there you go. This is what community is all about, right? So Tim answering Clinton's question. Now, obviously, Tim might have got it wrong, right, Clinton? But in this scenario, I think Tim's got it. He's nailed it. Tim's got it exactly right. So you're hearing it, hopefully, from the horse's mouth from me. But I will talk about that. So, yeah, gold star, Tim, and great question, Clinton. Okay. So let me wind back in here, though. But the markets last week, right? So there were kind of 3 events. They're picked up in here on the title. Hawkish Fed tone, US Sino tensions, strong Dobbs data, but, and the big one there is the but, still risk on. So markets had interpreted. So 2 weeks ago we had the Fed, and we've been talking a lot about this, the view of this Fed pivot. Okay, that the Fed had pivoted from what Powell had said away from a more hawkish tone towards a more dovish tone. It doesn't mean they're going to stop hiking rates, but what it means is that maybe they're not going to be as aggressive. Maybe the peaking rates is not going to be as high. Okay, and I've been saying though that a lot of market commentators have said that the market had actually misjudged this, and the Fed weren't really pivoting that aggressively away from hawkish towards dovish. And the Feds tried to basically rail back on that. They tried to question the narrative that the market. So again, look, last week, several Fed officials pushed back against this dovish market narrative and indicate the central bank is still steadfast in raising rates until inflation is under control. So that's what happened. And remember, some of those Fed speakers weren't the natural hawks in the Fed. In fact, Kashkari, who is a natural dove in the Fed. Now, if you go to in here, and so we go to ITC. Oops. So ITC are a broker in here. Sorry, not a broker. They are a provider Squawk service. I think they may have this on the live Squawk, who's our Squawk service. But I've got But if you go in here, I'm going to share this in the. This is a great little resource. Okay. I think Live School got this somewhere on their site as well, but if they haven't, they definitely got it here. So this central bank hawk and dove sheet, right? It's a great little resource. I just put it in the chat. ITC markets are the people who do this, okay? And if we click on the one with the Fed, it gives you the current Fed, who's in the Fed and who are the more dovish. So at the top here, we've got most dovish, you see, and down at the bottom, most hawkish. You see Kashkari is amongst the most dovish, okay? It's also got whether they're a voter at the moment and going forward, okay? So Kashkari isn't a voter at the moment. He's a voter next year. But nevertheless, they still have input. They still sit on the MPC, okay? And they still have input, but they don't get to vote on whether they raise rates or not. But even Kashkari last week, who is a very much one of the more dovish of the MPC, not the MPC, sorry, MPC, the FOMC, okay, the FOMC. The MPC is the equivalent in the UK. Sorry, I was writing an article on the MPC earlier on. The FOMC, okay, Kashkari is one of the more dovish, and even he railed back. So in here, this is what I'm talking about here in this article. So that was one of the things we saw. So we had a shift back to more hawkish, okay, slightly more hawkish from the Fed and pushing back on this more dovish market narrative. We also had, as you all know, Pelosi went to Taiwan. There's been some saber rattling with some military drills in the Taiwan Strait, the most aggressive China have been. Also, China broke off diplomatic talks on military and climate environment. Okay, funnily enough, those are the two things that the US are more interested in, keeping the dialogue on the military side, and on the environment, on climate. Those are the things that are more interesting and on the agenda for the US, right? Interestingly, what China didn't do, China didn't break off the trade talks, right? So they're in negotiation with the US to pull back on the more aggressive sanctions that were put in place under the Trump administration, right? And so, funnily enough, we didn't see a move on that, okay? So we didn't see them saying they're going to break off diplomatic talks on trade, because that's in China's interest, okay? So we had those two things happening, right? So we had the Fed and we had that. And that's, again, both of these are kind of risk-off events. By risk-off, we mean investors, traders wanting to take less risk in the market, okay? So that's a risk-off event. This is a risk-off event. Now, turning to Clinton's point here. So Clinton then goes on to say, so then is the rate hike significant enough to outweigh the jobs report or just an intraday reactive drop? So yeah, so what happened is the payroll numbers, the employment report, was a massive beat. Okay, the unemployment rate fell to 3.5%. The payroll data was 528 with an expectation as 250. So it almost added double what we was expected. And also the May and June estimates were combined, revised up by another 28,000. So that's another 28,000 it beat by, okay, overall. Now, the reason that, as Tim has said, the reason, so previously the Fed had been looked to pivot to more dovish. Then they pushed back and said, yes, we're staying quite hawkish. And then this jobs report allows the Fed to be more hawkish, right? It's going to allow the Fed, because clearly the jobs market is not cooling down, right? The jobs market, the labor market, even though the consumer in the US, and I might add the consumer globally, is slowing down, jobs markets are still very tight, okay? It's the same here in the UK. The jobs market is very tight. There's a lot of jobs out there. There's a lot of availability. And so the job market being tight means that potentially wages could stay inflated, right? Because if there's a tight jobs market, then everyone's chasing the same workers. So that's going to push potentially wages up, which then in turn could push up inflation, okay? And also, if the job market's strong, then that means then people are more confident in their spending, and that's not going to slow the economy down. It's not going to slow the consumer down. So what it means is the Fed could be more aggressive. So then is the rate hike significant enough to outweigh the jobs report or just an intraday reactive drop? What it means is, and I hope this is going to be clear, what it means is the Fed, we thought the Fed may be going to peak in rates maybe making exactly a wage spiral, Joe. Yeah. So we were thinking the Fed are going to peak in rates 100 basis points up from where we are right now, and then if we looked about a week ago, there was the CME tool. Okay, the curve was telling us they were going to start cutting somewhere between March and May. Now, if we go and look at the CME tool now. Okay, now look, this, if you remember, after the Fed, this column here, which says 100, the next rate hike, the September rate hike, this was up here, so this was up nearly 80%. And that was saying, this column here is saying up to 275 to 300, which in here, okay, is up 50 basis points from current. Okay, there's the current 225 to 250, 275 to 300. So the next meeting, this straight after the Fed meeting, so that was 2 weeks or a week and a half ago, this was up at 80%. And even last week, then this dipped lower and then it kind of rebounded ahead. It dipped lower after this happened. Oops, wrong one. After the Fed pushed back, after the Fed officials pushed back at the beginning of the week, this column in here dropped down in here to about 55, 60. Okay. And then there was only an outside, more chance of a 50 still than 75. Look what's happened since, right? Boom, down here. Now only around a 30% chance of there being a 50. Now we're saying more likely for 75, because this basically, the jobs report allows the Fed to be more aggressive, or even encourages the Fed to be more aggressive on interest rates, because the economy is not slowing down as much as they would have wanted. Does that make sense, Clinton? Okay. And if we look further out, okay, now previously the peak in rates was at 325 to 350. Look what now going into next year. So by the end of the year now, it's at 350 to 375 by the end of the year. Okay. So by the 14th of December meeting now, we're expecting 350 to 375, which is up 125. The pre-kim rates was only 100 up from now. So we're adding on another 25 basis points of hikes, right? And then if we go into next year, it stays at 350, 375. Going into March, 350, 375. Going into May now, you see 350, 375. By May, we were expecting rate cuts. Yeah, the peaking rate was below the peak come May. Right now, we're out into June, still 350, 375. So now, no cut by June. If I go out to July, 325, 350. So it's only by the July meeting that the market's starting to price in a cut now. Okay, so basically what we've said is a more aggressive cut coming up at the next meeting. The peaking rates by the end of the year is going to be higher, and the rate cuts are going to come further away. So all of that is a more hawkish shift, right? And so effectively that more hawkish tone is more negative, less positive for stocks. So that hence stocks sold off. So is it just an intraday reactive drop? My view is probably yes. I think, but the market here, the curve is still telling us the Fed is still hawkish. But as I say in the article here, not there, here, hawkish Fed, yeah, we had at the beginning of the week, the tension with China, and then a strong jobs data. All of that, though, the market's still very resilient. It still ended up, US stock averages were actually up on the week. They still ended up on the week, okay? They were still higher on the week. We go down and look at the charts in here. You can see a green. Oh, that's the yield, sorry. You can see in here, we actually nudged up on the week last week, okay? We had higher on, and the European stocks are higher as well. So for me, even though we dipped off the highs from last week, I think this is a buy opportunity, I would say. If I'm a swing trader, I think Friday's sell-off is a buy opportunity, okay? Right, I'm going to quickly go back and run through the rest of this. So does that all make sense, guys? Yeah, you got that, Clinton? Got everyone else, right? So stocks were up, but yields were lower, and no surprise the yields were lower, right? Yields were higher. Yields jumped back higher in here, having been pushing lower. You can see in this chart here, yeah, the yield chart. You can see having been pushing lower since the last Fed meeting, okay? The 2 meetings ago, sorry, back in the June meeting. Since the June meeting, we've been tracking lower, yeah. And then last week, after this shift back in the Fed and because of the jobs data, yields went they were originally lower and then ended up higher. Yeah, so in here, but again, I think this is going to fade. I think we're going to see this roll back lower. I think yields are going to end up going back lower in here. Okay, so what else do we have in here? I'm just going to finish up on here. So, yeah, that's the reaction of the markets in here. There's a very, very quiet. We've got nothing really from any big central banks this week. Okay. Oh, the other thing I need to just say in here that the Bank of England, I know it's not really impacting you guys, but the Bank of England hiked by 50%, 50%, 0.5% in here, 50 basis points. It was the largest increase. It was very much expected, but the largest increase for 27 years by the central bank. But they projected inflation. Remember, the UK are kind of been ahead of nearly everywhere else with their inflation numbers. 13.3%. We were aiming at around 11% before, right? The bank now thinks 13.3, massively higher, right? And this is due to surging energy prices. This is impacting Europe as well, okay? The high energy prices, right? Looking into the week ahead, right? We've got a quiet week on the data front overall, but we've got a massive piece of data. We have Chinese and German CPI on Wednesday, but critically US CPI. It's going to be massive, right? If that number is higher than expectations, you can fully expect stocks to see a significant sell-off, I think, particularly given the fairly hot, as in hot, strong jobs report. A strong jobs report and still pushing higher on CPI, that's going to be a worry. So that's going to be critical. We'll talk more about that on Wednesday, okay? But that's the big data point of the week. You can see ahead of there, nothing of note. So, as I was saying right at the beginning of the webinar, the chances are, given that we've got a huge piece of data for not just the US market, but global markets here, okay, on Wednesday, and we've also got Chinese and German CPI. Germany, the biggest European economy, the powerhouse of Europe. We're going to be definitely watching their CPI in the morning, and the Chinese CPI as well, ahead of the US CPI. But that's US CPI is a massive piece of data. It's going to be watched, okay? And because we've got nothing ahead of there, it's probably going to mean that we're going to have less volatility in the early part of this week. The market today is going to digest the US jobs report from Friday. I think we're going to get a rebound, is my view. We've already started to get a rebound already in here thus far this morning. But what I'd be looking for then is probably tomorrow markets to really quieten down ahead of the US CPI number. Okay, so that's looking forward. All right, let's run for a few stories in here. Let me bring up 5 things to start your day. Okay, the inflation scare, CPI this week. Okay, the perennial question remains: are we near the peak? BlackRock Provodio Jeffrey Rosenberg believes we're going to see inflation decline, but asked to what levels? Okay, that's going to be critical as well. Yeah, we may have seen peak inflation, but is it going to come down? Okay, and so that's going to be critical to watch in here. And we get Fred speakers in here. All speaking this week. We get Evans, Kashkari, and Daly. Okay, all speaking later this week apparently. But not today. If we go to today's, I think we've got nothing. Yeah, nothing of note today. Look at this calendar in here. Nothing really of any significance coming through today. What else do we have? But CPI is going to be critical. Senate passed a landmark tax climate healthcare bill. Is that impacting us? No. Okay. Investors in US corporate bonds haven't seen a worse year ever. Okay, corporate bond markets looking very, 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 very negative in here. That can be potentially a bad sign for stocks. However, at the moment, it's not impacting. We've already had the negative impact throughout early this year, impacting into stocks. Okay, European stocks have rebounded this morning, and equities are also higher. Just a rebound in here. I think this is the rebound that we're going to probably see coming through today. This is as now traders and investors react to the jobs data. Okay, the knee jerk, as you say, the intraday reactive move is a drop lower. Clearly strong market, boom, it sells. We get liquidation. Yeah, I think what we're seeing now is okay. This is a buy opportunity. It's not as bad as we kind of think going forward. It's okay. The Fed might be a little bit more hawkish, but what are they telling us in here? What's that Fed tool telling us? Well, at the end of the day, we're talking about another 25 basis point high. It's not great, but it's only saying we're going to get maybe a bigger reaction at this meeting, the next meeting in September. We were expecting maybe only 25. We were expecting only 50, and now we're pricing in 75. But then the rest of the year we're expecting as normal. So the peak's going to be 25 higher. Maybe the cut comes a little bit later. It's not a massively aggressively different move. We're talking about an extra 25, and this could undo as well. We could see the market pull back on this as we go through the summer, as we get further data. This could all reverse. This could be back up if we get a very soft piece of data from the CPI data. If the CPI is a lot lower than anticipated, okay, then this could easily reverse. This could be back up here only expecting 50, and this could be backing down here So this could be back about 80% easily if we get if inflation shows sign of peaking. Okay, what else? 5 things we want to tell us. Stocks time, yeah. So a quiet day on the data front. We've already covered that. So in here, US stock futures rise overnight as traders assess the Fed hikes. Okay, so that's exactly what I've been talking about. Investor attention turns to US inflation data later in the week. Okay, but strategists in here look see dimming profit outlooks. Okay, the yen trade is crumbling. Okay, so we've seen a significant dollar yen move over the last few days in here, and dollar yen significantly lower, rebounded back higher, but on Friday, so dollar up, yen down, but that weak yen trade has certainly started to be unwound in here. Oil endurance has probably started to the week, okay, but it was a very negative end to last week. Very, very negative end. For me, oil looks like it's got a massive top in it. It looks very, very negative in here now for oil. And if we look into what we got in here, looking into today, going into today, just quickly go in here. I just want to duplicate that. I just want to show you European stocks as well. So if we go take a look at US stocks on the lead up in here, so we are up about 0.5%, about a third to 0.5%. Nasdaq's up 0.5%, so clawing back losses. And look, and actually we were up in the end on the Dow on Friday. If we go take a look at European stocks this morning in here, sorry, closed this one down earlier on. Go look at the European stocks, and you can see we're healthily up in here, about between 0.5% and 1% on the European stocks. FTSE, UK, DAX, Germany, CAC, the French index up between 0.5% and 1% in here overnight this morning. We've already looked at the Fed tool. Let's go take a look at a few charts. I'm just going to concentrate on the S&P and Nasdaq in here today. So you can see this healthy rebound. Let me go for the daily chart first of all in here. On the S&P, make this bigger. Get rid of this. Don't want this on. Bollinger Bands. Okay, so you can see in here, despite the fact that we sold off, look, we actually rebounded into the close, and we're almost back up towards the highs from last week on the S&P. Okay, and then not too far above there, critically up here, we see just one sec. Oh, where's my data box gone? Okay, up here we got the peak up there at 42.04.5. Okay, real risk of a push up to challenge that potentially today. The peak in here from last week is 41.73.25. So through 41.73.25, and if we go into the 15-minute, you'll see in here the market looks really strong. We've had that rebound. There's the Friday sell-off. There's the subsequent rebound, then choppy, but it's fairly resilient close, and then overnight in here, pushing all the way back up to the highs, okay? And there's the peak there. So we've just stalled ahead of the peak from last week. No surprise, you've got multiple peaks around here, but you can see we've gone above nearly all of the peaks apart from the actual high. You see the peak, that's where we sold off on the data, okay? That was on Friday on the data. We're above that peak. We're above the peak from before then. We're above this peak from over here from last week, from the 3rd. And then the only peak, the actual high from last week, is the only one we're not above. I think there's and look, we're seeing we have a little pullback, and then we're already bouncing. If we look at the little internal trend line just on the rally in here, actually just the whole trend line. Okay, so that one doesn't really work. Okay, so we could either redraw this one off of here. Excuse me. We redraw it out to here, which works a lot better. And then you get the third touch as well here. And then look, it comes in. So this is the trend line. So it's up the low there from Friday. And then this low in here is, I've got this, well, this is my time, okay, but this is from this morning, okay, through that low there. So that's 2:15, 02:15 my time, which is going to be, I can't do it in every single time zone, but it's going to be, if I do Eastern, it's going to be last night at like, 5 hours before that? So let's say like 9:15, 19, that's 2100 hours then, 21:15. Okay, that's going to be, okay, on Eastern time. Yeah, so it's rebound. That's where I've drawn that off of there. And you can see you get third touch and then it comes close and comes back and now dips and rebounds. I fully anticipate us challenging today's high and then last week's high and then going up to the peaks here and maybe up to there 42, what did I say, 04.5 was it? Oh, can't quite see. 42.0475, yeah, easily up to there today and maybe a little bit above. Okay, let's go and look at the Nasdaq. Similar story, obviously. 13 period. I don't want that simple either. Let's remove that. I'll come back to do that afterwards. Okay. Here's the Nasdaq again, dip and a rebound on Friday, and then higher back in here today. Same kind of story in here. Overnight, the Friday peak, it was the peak from last week. Looking for a move up to that peak, and that peak there is from Friday's peak is 13,384.5, and then above there you got this string of peaks from the where we go from 13,580 basically. 13,578, 13,582, 13,576, and that peak there, 13,620. So basically 13,570 to 13,620. Easily think we could maybe push up towards those levels there. That would be my upside targets. Onto the 15-minute chart on the Nasdaq in here. Not looking quite as bullish as the S&P, okay? So there's the Friday sell-off. There's the subsequent rebound. Lower again. Came back. And then this morning, grinding all the way back up higher. And you can look at dip and a rebound. Again, if we put the trend line on, I don't think this one here is going to work. Oh, actually, it works perfect. Yeah, look, same trend line basically. And then look, third touch, and then look, multiple touches here, and it's gone back down. It's rebound. It's a great trend line, that one. Again, that's off the low from Friday, and then the low there. Again, that's so I got it 2:15, 02:15 my time. So work out wherever that is your time, guys. Yeah, I'm on British summer time. Yeah, so I'm drawing off that low there, and then boom, 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 boom. Look, it's playing with it there. Impulsively moved away from that just over an hour ago. Okay, and then back down to retest and moving away. It's a great trend line. Yeah. So yeah, up through today's high. You got this impulse point from Friday. So the S&P not quite done as well. Remember, sorry, the Nasdaq. When we looked at the S&P, we said it was above all these peaks. Right, there's the sell-off from just before the data. Right, we're above that. And this peak and this peak, we're above all these peaks apart from that one peak. If we look at the Nasdaq. Okay, we're not quite there. Yeah, so we're not back above the sell-off peak. There's the sell-off peak, and there's Friday's peak, but we're above these peaks from over here. Yeah, so we actually made a new high back on Friday on the Nasdaq, which we didn't do on the S&P. If you look at the S&P, the peak on the S&P came on Thursday. Yeah, where the peak on the Nasdaq came on Friday here. Yeah. So, it's all just looking bullish to me, guys. I've not got much more to add than that. Given the time, we've been going for about 30 minutes in here. I'm going to wrap it up there. We'll take a look at oil and gold. Actually, it won't be tomorrow. It won't be till Wednesday. But I'm going to wrap up there if there's no questions. Have a great trading day. Remember, no webinar tomorrow, unfortunately. We won't be able to cover the webinar tomorrow, but we will be back with you on Wednesday ahead of that all-important CPI data. Have a good one, guys. Have a great trading day.